Hey guys, so here is an advanced video of trading using supply and demand, or you can consider it a part 2. So just before I get into the video, if you've not watched the first video of supply and demand, you won't understand anything in this video. So this is basically a continuation. So I'm assuming by the time you're watching this video, you do understand all the basics of trading using supply and demand. If that's not the case, then the link is in the description. You can find my previous video where I've explained clearly how to trade using supply and demand. Supply and demand is my main trading style. Literally, if you've been following me, you know that. This is how I approach the markets every day, every week, every time I'm analyzing. It's always about supply and demand, as you can see from my charts. Here is my latest setup, which I said today, a very successful setup using supply. So since I did the other video on the part 1 video, I've got so many, you know, texts from people showing me their results, how they've been applying supply and demand and how it's working for them. So it's a very exciting thing. But at the same time, I've also seen a lot of people experiencing some key challenges when trying to apply the concept of supply and demand. So I've summarized the top challenges that I've seen you guys maybe um, going through. So the first thing is people struggle to know how to correctly mark the supply and demand zones, because if you're not very keen on how to mark it, then you're going to miss the zone, because there's a very specific way to mark the zone. Second thing I'll also share in this video is what time frame should you use to mark the zone. I get that question asked a lot. Then at what point do you know if the zone is still valid or invalid? Then another thing is, must you trade against the trend, or can you trade? I mean, must you trade to the direction of the trend, or can you trade against? People also ask me this a lot. Then there's also a concept of low probability setup, which is the seventh thing. So there are setups using supply and demand that actually have a very low probability of becoming successful. If anything, they are more likely to hit your stop loss or just frustrate you. So I'll also cover that. Then I'll also include the break of market structure, how to use the break of market structure to make sure you don't miss any zone in the market. Then remember, anytime you miss a zone, you're missing out on a potential setup, so you don't want to miss any zone. And then finally, support and supply and demand, and how it can turn to become support and resistance. And you'll see how you're going to apply it to find a setup. Make sure to stick to the end of this video, because I'll be answering all these questions. And if you thought you're good at trading supply and demand from watching the part 1, well, now this part 2 is what seals the whole deal, because we now complete the whole picture. So by the time you're understanding every concept in part 2 and you combine with what you know from the first video, your supply and demand analysis will be close to perfect. And once you have that analysis close to perfection, then that means it's going to increase your win rate and you'll be going for only high probability setups. So it will help you to avoid making silly mistakes and getting confused any time you're trying to apply the strategy. A disclaimer, what I'm teaching you is my trading style. So supply and demand is a general concept. If you just search on YouTube, you're going to get many people who take the concept differently. So these details that I'm giving you in these videos, these are specific approaches that I've been backtesting in the market, and they are things that I've discovered on my own. So the whole concept of supply and demand is general. Yes, you can learn it anywhere, but these specific approaches in terms of how I get the setup, in terms of how I mark the zone, um, how you can apply it with support and resistance, those are concepts that I'm teaching you based on what I've been backtesting and what I've realized is working well for me in the long run. So if you've watched a different video of supply and demand and you find this one contrary, don't be shocked, because everyone has their own trading style and approach. We trade different pairs, different instruments. So what I'm telling you might be working for me, maybe on the 1 hour time frame, because that's the time frame that I trade, but you might find someone else with a different approach but using a different time frame. So each strategy is valid as long as you have the data to back it up. So first thing, how to correctly mark supply and demand zones. I'll start with demand. So remember, every time you want to mark a demand zone, there must be an evidence of a higher high and a higher low. So the series must not be so long, but at least there should be evidence of higher high and higher low. Then each beginning of this impulse move, the impulse move is the move to the direction of the trend. So since we are having higher high and higher low and the market is moving upwards, each beginning of this impulse move, we have a demand, same thing here, same thing here. So in this example, this is the first demand zone here, second, third, fourth. As long as we have the series of higher highs and lows, the demand zone keeps on forming at this place, and it keeps on moving up because this is our demand one, demand two, demand three. So the more the higher highs and higher lows, the higher the zone is also moving upwards. So practical example, we do have a series of higher highs and higher lows here. If you check, so how do we identify the zone? It's very important for you to get the zone correctly, because when you miss this or when you make a mistake on this, then you're most likely to get a low probability setup. So you come and you mark your zone from the lowest point of the impulse to the first significant bullish breakout candlestick since the market is going up. So this is where the low is. If possible, you can even come and zoom in to make sure you don't make a mistake. You want to get the very low from where the wick of the body is to our first significant bullish breakout candlestick. You can use this one or you can still use this breakout candlestick. There is no perfection as long as you don't use this, don't take a candlestick that has moved so far. You want at least the immediate candlestick somewhere around here. So you can use the first one here or this second one because it is also a breakout candlestick. So you come and you mark. So the zone starts from here below. I'm just extending it to the left and right so that you can get the whole idea. The zone starts here and I've marked it to this candlestick, this one. And you make sure it touches the wick of the candlestick, not above, not below. So that's how our zone looks like. Then we come and extend it to the right. So now that is how we correctly identify our demand zone. I'll also do a second example just to confirm. Here, this is where our low begins. Then we do have a significant bullish breakout or momentum candlestick. So this is also another potential demand zone at the moment. Not potential, it is a demand zone. So I've marked from where the low is to the first candlestick to its wick, then you extend to the right. So in future, when price comes and trades back to this zone, I'll be looking for a bullish setup. So that is how you correctly identify a demand zone. Supply zone is the exact opposite. In this case, we want the market to be dropping, so we must have a series of lower highs and lower lows. Nothing else, lower highs, lower lows. So each beginning of the impulse, the move to the downwards becomes our supply. In this case, we can easily identify that the market traded low. We had a lower high. We had, let me see, yeah. So this is just a rough sketch of market forming lower highs and lower lows. So each beginning of an impulse, we have a supply. So I can use any random one like this one. So I'll mark from the top of the wick, and you want to take the supply to the first significant bearish momentum candlestick. So this next candlestick is quite significant, or you can still use the next one as long as you don't go too far. Again, remember that. So you can use the first candlestick or the second one as long as it's just somewhere near. You don't want the zone to be very thick, by the way. In fact, the whole secret of demand and supply, let me tell you, the bigger your zone, the lower the probability that the lower probability of the setups. Because if the zone is too big, this is what is likely to happen. If the zone is too big, the market could come here, give you the first fake out, hit your stop loss, second fake out, stop loss, then it now gives you a third entry, which now goes to profit. Yeah. So the more thin your zone, the more refined your zone is, the higher the probability of the setup that will be formed. Next thing, what time frame should you use? So with my style, I use the 1 hour time frame for entries. But when marking the demand and supply, I use any time frame from the 1 hour and above, preferably the 1 hour, 4 hour, and the daily time frame. So the whole thing is From my backtest, you can easily mark your demand and supply using the 1 hour comfortably, and you'll still be able to be very profitable. But in the case that you're looking at your 1 hour and you cannot see, let's say, a demand that is somewhere close or a supply zone, what you can do is that you can switch to a higher time frame like the 4 hour and try to go back in time and identify any demand or supply that is still valid, of course. Or if it's not on the 4 hour, you can go a little bit higher on the daily time frame. And here's an example. So let's go to the 4 hour time frame, try to look at how the market is behaving. Very easy to identify series of higher highs and higher lows. So I'll just pick any random. So here, this beginning of this impulse, let me mark the demand using the 4 hour. So I'll come from where the impulse begins, and I can use this candlestick as my first breakout candlestick, this green one, because it is significantly long. So I'm marking using the 4 hour and it'll extend to the right. So anytime in future when price trades back here, this is a valid demand zone. But then remember, all my entries I use the 1 hour. There's no negotiating according to my style. All my entries are 1 hour. So I could get the zone using the 4 hour daily time frame, whatever, but the entry, the confirmation must be on the 1 hour. So let's go and narrow down to the 1 hour and see how the market behaved at that point in time. So the zone now you can see it, but we did identify it using the 4 hour. So I can already spot a very clear confirmation, like here the market formed some sort of W pattern. So if you took a buy position here, you probably, not probably, you did have a very good setup. So that's it. We have a very good setup there already. Also, the market came back again sometime in future. Sometime in future, it also came back here, went back up, still came back to the zone again, gave a very clear pattern. If you check carefully here, I even took these trades, I remember them very well. So I always take my entries at the neckline again. I'm assuming you've watched the basic video. So here, this is where we're going to take our buy position. Yet again, another very successful setup. So these are a good example of how you can mark your zone using a higher time frame, as long as you still come and narrow down and look for your entry in the 1 hour. So yes, that also works. Another key point, when is the zone invalid? Some people struggle to understand. So it's very simple and clear, and don't confuse yourself. There is no in between. Very straight to the point. So as long as the zone has not been broken below and the candlestick has closed below, the zone is still valid. Now, if the candlestick comes and closes trades below the zone, like this one, this candlestick, as you can see here, it traded below the zone, right? But it came back and closed inside the zone. So it closed as a rejection within the zone. It is still a valid demand zone. It could have only been invalidated in the case that price comes and trades below the zone and we find any candlestick closing below the zone. The moment we just have our first candlestick that will break below, and the time frame closes below the zone, the 1 hour, of course, that zone becomes invalid. Of course, even if it's the 4 hour, any time frame moving upwards. But as long as the zone has not been broken, the zone can be used over and over again multiple times. So for instance, this zone that we marked on the 4 hour, currently it was used, I think, about 3 times, because from when we marked, we found our first setup maybe here, second setup, third setup, fourth setup, yeah. But the zone has never been broken. If you look carefully, there's no candlestick that so far has ever come and closed below this zone. So this zone is still valid. So in the case that in future Euro New Zealand dollar comes and trades all the way low here, in the case that this ever happens, on the 1 hour time frame, I'll be looking for a bullish setup as long as the zone hasn't been broken. Yeah. But if it comes and now breaks finally, eventually, below the zone, this zone becomes invalid and we delete it. Once a zone is invalid, it will never be used again. You delete it from your chart forever and ever. So you'll always be looking for new zones. If it's invalidated, you delete it forever. Don't even try to anticipate to use a zone once it's broken. That becomes a very low probability setup. The opposite is true for a supply zone. So as long as the zone hasn't been broken, it's still valid. It can be used over and over. So I want to show a good example of a zone that was broken in real time. So here, let's just check carefully. We had this series of lower highs and lower lows. At this current price, you had not seen what the market could have done in future. So at this current time, before you see what happened in front there, this was a valid supply zone, yeah? So if you come and mark the zone from where it starts to that first breakout candlestick, and you extend to the right, yeah. So if you check carefully, what happened is that eventually we had our first candlestick that closed above the zone, so it broke up out of the zone. But if the candlestick could have broken out of the zone and it comes back inside and closes as a rejection, the zone is still valid. So anytime we have a breakout out of the zone like this, the zone is invalid, so it is no longer supply. You delete it from your chart. So there's a mistake that I've seen people doing, whereby um, this zone has been broken, then you come and still extend it to the right. Then in future, you still come and look for a sell setup here using the same supply. There's nothing like that. That is your own strategy. That doesn't exist. Once a zone is broken, it becomes invalid. You delete it, you continue looking for the new zones. Remember, the goal is to try to get the highest probability setups. For you to get the highest probability setups, you have to eliminate anything that um, will give you just many random setups that don't make sense. So you want everything to make sense according to price action behavior. Next issue, can we trade? Are we trading towards the trend direction, or are we applying supply and demand against the trend direction, or are we doing either? So the answer is very simple. According to me, I don't try to focus on the trend. All I look for is series of higher high and higher low to mark the demand for a bullish position. For a bearish position, there must be some evidence of lower high and lower low. So the whole reason I'm telling you this is because the trend in the forex market really depends with the time frame that you're trading, really depends with the kind of vision that you have. For instance, if you look at the market right now, yeah, if you just zoom in the chart to fill the whole screen, from this side, which is probably the left to the right, we are having some series of lower highs and lower lows. So you can argue the market is in a downtrend. Same thing if we are to drag the next screen and we zoom in, we are having lower highs and lower lows. So the market is in a downtrend, right? So you can say we are selling. But then if you come and zoom out the whole chart, if you zoom out the whole chart from the beginning, you can no longer say the market is in a downtrend. If anything, we're in an uptrend, we're having higher highs and higher lows. So if your argument is that you are trading the trend, what type of trend are you going to, what type of trades are you going to be taking here? So the whole reality is, don't be focusing on the whole trend. What you just need to know is, be in a position to identify higher highs and higher lows and the break of market structure, which I'm just about to cover. But once you can do that, it does not matter where the trend is going. The setup will still work. Here's a very good example. The market here was dropping quite significantly. I want you to just check from this point to here. The market had dropped with about 272 pips. If you look down here, we had in fact, we had a long series of bearish candlesticks. No green candlestick, all of them are bearish ones. So if you are someone who will come here and start arguing the market is going downwards, we can't be buying here, you will miss this setup. Yet it was at a demand zone. So your work is not to try and identify the trend. Your work is to follow the demand and the supply. Because I've told you the trend varies depending with how you're looking at the market. If we zoom out, we are still in an uptrend. If we zoom in, we are still in a downtrend. Yeah. So just take the trend. Here is another good example also of a setup I had this week. The market was dropping quite significantly. So if you're here arguing that GBP card is in a downtrend and you are looking for sell positions, while I was taking a buy position, and real time by the time I was taking the buy position, it looked very risky. So you might even doubt why maybe I'm taking a buy position. But it's because I'm following my strategy that I've backtested and I've proven in the market that it works regardless of the trend. So don't focus on the trend direction. Focus to be in a position to identify the higher highs and higher lows correctly so that you can get the correct demand and supply zones. Whether the trend is going up or down on whatever time frame is none of your concern. The setup will still work. And just to clarify, the reason why I'm telling you the trend is not a big factor is because I want you to realize one thing. I'm not a trend trader. I am a supply and demand zone trader. Now, once you are trading with the supply and demand zone, this is the whole secret that people need to understand. I'm not trying to predict where the market is going. I'm not trying to predict how far it's going. All I know is that we are going to have a bullish reaction here. So I want to take advantage of the bullish reaction and the demand. All I know is that at supply we should have some bearish reaction. And just check. These are supply zone that I had marked. See, every time that price came here, we had a bearish reaction multiple times. So it is proven and tested that at supply we are going to have a possibility of a drop in price. It is proven and tested that at demand we are going to have a possibility of a price pushing upwards. How far it's going to go is none of my concern. I'm not trying to predict that this market is going to trade all the way to the next to the previous high. Now that's one thing you need to understand. That's why I'm telling you I'm not a trend trader or anything of the sort. So what I do is I have backtested my strategy and I've already determined that every time I target 90 pips at a demand zone, I have a 70% chance of hitting it. Yeah. So if you look, this is a demand. I had a 90 pips take profit, it was hit. Another demand, 90 pips take profit, it was hit. This was supply. I had a 90 pips take profit, it was hit. This is an example of how I don't know how far this drop would happen. Because if you look at my setup, sometimes people ask me, you bought here and you exited at 90 pips, and after exiting the market went all the way up. Why didn't you hold all the way up? Because my strategy does not factor in how far the market is going. I don't know how far it's going. I don't try to predict how far it's going. All I know is that we'll have a significant reaction, and this reaction might be enough to give me 90 pips, because there are so many times that this market will just come and buy with about 97 98 pips, then it continues to drop. Even if it continues to drop, yes, you might be right that the market is in a downtrend, but guess what? When it made the 97 pips move, I have already exited at 90. So I've still got the setup. That's the whole idea. Same thing with the bearish setup here. At supply, I got a bearish setup, but I didn't know how far the drop was going. I mean, if I was a trend trader who tries to predict how far the market is going, then maybe I would be smart enough to come and target 150 pips instead of targeting the 90 that I targeted. But I don't know how far it's going. All I know is that I have a 70% chance of hitting 90 pips. So I only target my pips. And I'm an intraday trader, and you can see most of my setups are very short, that they are closing within the same day, most of them. So that tells you I'm not here to try and hold the market. I mean, to hold the trade and respect, I don't know, the whole trend. That's not what I do. So I hope you now get the whole concept. Because someone who is trading in a trend direction, someone who's trying to predict the whole trend, their approach might be quite different. But for me, that's not what I'm doing. Next thing is support and resistance. So guys, I know you probably know of support and resistance, and you know that support is a line somewhere below where the market is unable to break. Meaning, for example, if this is support, what we are saying is every time price comes to this zone, it's unable to break the zone continuously, maybe 3, 4, 5, 6, 7 times. So the line becomes a line of support. Resistance is the opposite. Resistance now is somewhere above, and somewhere above here, what happens is every time price is coming to this line, it's unable to break, unable to break, unable to break. So we can say that the buyers are, is it the buyers or sellers are holding price? So it's becoming difficult for buyers to push up. So it keeps on bouncing off and coming back down. That is resistance. So the whole idea of demand and supply, how you combine it with support and resistance is very simple. You see, initially we have a demand zone here. I just want to follow. We've marked the beginning of this impulse. We had a very strong impulse move from here to there, another retracement. Yeah. So long story short, this is a demand zone. So it comes and works time number one. The first retest, we get a W pattern and a bullish setup. But then the zone hasn't been broken. So the zone is still what? Is still valid. Then price comes back in future again and gives you another setup. Now, anytime price comes back to this future and is rejected price is unable to break the zone for now a second time. The zone now turns from being just a normal supply, a normal demand zone, but it now becomes also a zone of support because price has been unable to break through the zone severally, so it becomes a zone of support. Now, the advantage is at a zone of support, we have a very high probability of getting a good setup. What that means is we had a fast setup. Now, this fast setup, sometimes it's even possible for it to fail and become a fake out and the zone is broken. But in the case that the fast setup works, then the zone is still valid and the market comes and retests again. Most of the time, I think this has about a 90% win rate. This second setup that forms in the same zone has a 90% chance of becoming successful. So the opposite is correct for supply. So this is a good example of we had an impulse, marked my supply zone. Price came and gave a retest to the supply, gave me a good setup, hit my target easily. So that's the first setup at the supply. But then the zone is still valid. The zone has not been broken yet. So you come and scroll back, fast forward, in future price came and again retested the same zone. So now this time, it is just not a normal supply zone. It is a supply zone that can also be factored in as a resistance zone, not a line zone because it's a whole zone. So it's a resistance zone and also a supply zone. So when it's doubling as a resistance and a supply zone, it simply means the zone has a very high chance of holding, meaning chances of price coming to break above the zone now at this point are becoming even more limited. Yeah. So this next setup is what I'm telling you is always a very high probability setup. After the first one, then it comes and gives you another confirmation later in future. That setup has a 90% chance of performing very, very well. So you see, gave us a good confirmation pattern. My entry is always at the neckline. I had a setup here, performed very, very well. It went as if it wanted to hit the stop loss, but eventually it still respected the strategy and came to the take profit. So that's how you apply the knowledge of support and resistance to supply and demand. In short, it just helps you to give more confidence that the zone is even strong enough. So you have more confidence in such a setup. We move to the break of market structure. So now, here you have to pay some attention. This is what is going to determine the difference between those who find all the zones and those who miss zones. Sometimes I take trades and then people ask me, I never saw that zone. So I want to show you why you never see the zone. So demand zone, higher high, higher low, right? Now, be very careful. We are forming higher highs and higher lows, meaning each high is higher, each low is higher. But the moment the low comes and closes below this one, it is we no longer have a higher low. So we say we have a break of market structure because we only want to be having higher highs and higher lows, meaning we want this low to be higher. But if the low comes and closes below that one, we have a break of market structure. So now here is the interesting bit. When we have a break of market structure, this automatically turns to become a supply zone, the beginning of that impulse. And any other lower high and lower low formation moving forward will be generating new supply zones. Okay? Supply, supply, supply. I hope that is clear. So again, the opposite is true when the market is now in a downtrend. Yeah. So let's say we were having lower highs and lower lows. So these are supply zones, supply zones. Each beginning of the impulse is a supply, supply, supply. Then we now come, instead of having a lower, how will I say, yeah, instead of having a lower high, this high comes and closes above the previous one. So it has now violated the lower high, lower low rule. It has closed above this. So this is called a break of market structure. So automatically, the downtrend has been disrespected, and this is a possibility of the trend to start going up. So automatically, this turns to become our new demand zone because price has traded above this one. So we are no longer looking at the downtrend. But each consecutive impulse of that will form a higher high and a higher low becomes a new demand, new demand, new demand, new demand. Demand, demand. So that's the whole idea, and I'm going to show you a very practical example. I took this setup today. It's already closed. And most people didn't see the setup. So some people have asked me, how did you get the setup? So now let me show you using the break of market structure. Now look carefully. We had a high, retracement, high, retracement. Then the next high can be considered somewhere around here, right? So I want you to look carefully. These are higher highs and higher lows. But then we have a break of market structure because this one didn't close below. So far here, this is still okay. But it eventually came and traded down below this low because we want higher highs and higher lows. So we don't want any structure that comes and violates this one. And in the case that price trades below to violate the low, we have a break of market structure. So this drop here signifies a break of market structure. And when you have a break of market structure, I told you, immediately this beginning of that high becomes what? Our new supply zone. And each consecutive lower high, lower low creates a new supply zone. Long story short, this is the next consecutive lower high and it created a lower low. Yes, this is a lower low if you look at the body. So that tells you what? Immediately this becomes a new supply. So you come and mark from the beginning of the impulse to our first breakout candlestick, which is this one to its wick and drag to the right, it becomes a supply zone. So most people don't identify these setups because they are not aware of the break of market structure rule. But it's important for you to know. So when you have the break of market structure, this becomes a new supply. So you can see I had a pattern here today. Market went up, down, up, down. Then this was my neckline. Came back to the neckline. I had my trade. Bearish setup, very successful. So that's how you apply the break of market structure. I won't lie to you. This requires a lot of practice. I'm just teaching you the concept, but you have to practice enough for you to be able to be seeing these things easily on the chart. Finally, we have the low probability setups. So this is something you have to pay attention. So what I consider low probability setups are things that I consider fake outs using the supply and demand strategy. So there are often times where you will find your supply and demand is too close. Now, for example, I target 90 pips as my target, right? So at demand, my strategy tells me the market should go up. While at supply, my strategy tells me the market should go down with at least 90 pips based on my backtest, yeah? So now let's assume I get a W pattern somewhere here and I'm buying, right? So if I come and take my buy position somewhere there, let's assume I even get it very, very early. I get it very early here. So that's my buy position. I have a confirmation. We're just assuming, yeah. My target should be 90 pips. Now, this trade has not even got to 90. It has just got to barely 64, right? Target should be 90. But at 64 pips, we've already hit supply. And at supply, the strategy is telling me the market should be selling. So now there's a conflict because this trade cannot even hit 90 pips. So the market is telling me, I mean, my strategy is telling me the market should be buying here. At the same time, it's telling me it should be selling. So should you be holding your trade, the buy trade, or should you be taking a bearish trade here? It leaves you at a point of confusion. So long story short, this setup has a very low probability of performing well. Anytime the distance between your supply and demand is very, very small and does not meet your target, you should not take the trade. This is a good example of a good setup. I got a setup here. My target was 90 pips, but here was the next demand. The distance between here, entry point to the next demand is roughly 136 pips. Yet I'm targeting 90. So 90 is within the range. See? But here, 90 is not within the range because 90 is at supply and at supply I should be selling. So does it mean I'll close my trade at 65 pips and start selling here? Yet my strategy says I should hold until 90. So it simply tells you these two zones will confuse you. So here I'll neither take a buy position nor will I take a sell position. So that is what I consider a low probability setup, which I think you should be very careful with. Any setup that the distance between supply and demand is too close, that does not allow you to hit your target comfortably, you need to eliminate such kind of setups. Otherwise, you're going to hit multiple stop losses. Yeah, so we've come to the end of the video. I've taught you some advanced stuff about supply and demand. It takes a lot of practice. The concepts are very simple and clear to explain, but despite me explaining, you'll find that you might still struggle to easily identify these things on the market. For you to be able to easily identify the distance is small between supply and demand, easily identify the entry pattern, easily identify the support has now become, this demand has turned to support. For you to easily just see all these things, it requires a lot of practice. So make sure you practice enough, and that's the only secret, that's the only formula. Also, I thought it's important to mention this strategy applies. Supply and demand works almost across all trading instruments, mostly currency pairs, even major currency pairs, minus crosses. Only that I've chosen to work with those that I've backtested and found were working well for me, because I like trading with the 1 hour time frame. I like trading. I'm not a fan of trading with very low time frames, but it works even across many currency pairs, even on lower time frames. I've seen very many people applying the same strategy, though of course everyone fine-tuned their strategy to suit them. So some people fine-tune their entries in a different way. Same way I look for M and W for entries, some people don't look for that. Some have their own things that they look for entries. Some people have fine-tuned their demand to look a certain way, but the whole concept is that it works generally across different currency pairs. So what I'll advise you is, anytime you learn from something, you learn something from someone online, like they have taught you, you might apply and it works for you. But it's so important for you to backtest on your own. Never just learn from someone and just go and copy paste and flip and just say I have a strategy. It's so important and necessary for you to do your backtest, because from the backtest you'll be able to determine some things that you prefer to eliminate, some things that work well for you. It's from the backtest that you'll be able to determine, maybe you're a fan of trading maybe gold. For me, I don't trade gold. You see the things that I'm trading, these are my 5 pairs that I'm trading, but I've determined it through my backtest. I know people who trade supply and demand, but they're applying it on Euro USD and they're still successful. But then their approach might be quite refined in a different way from mine. So once you understand the strategy, be like, make sure you do backtest consistently. Then you'll be able to determine which pairs work well for you. Also, in terms of your stop loss and your take profit. Like for instance, I target 90 pips. This does not mean everyone has to target 90 pips and use a stop loss of 45 pips. You could maybe backtest and find it is also working on a smaller time frame. And your stop loss could even be as small as 15, 20 pips, and your take profit also maybe 50, 60 pips. You don't always have to target all that much pips. So the whole advice is keep on practicing, keep on backtesting, and try to fine-tune a strategy to suit you as an individual. Don't just see something online and try to copy paste it. Because if you try, it might work, but not for so long, or it might frustrate you. Because everything that I'm doing, I have fine-tuned based on what is suiting me. It might suit most of you. Most of you might just copy paste and it works. But some of you might try to copy paste and still get frustrated copying the strategy. So after learning the concept, go back test, find what works for you. That's it.